1971, the birth of the screen-based stock market. On February 8, 1971, there was no trading floor, no bell, and no crowd. No one shouted, "Let trading begin." Instead, on the desks of around 500 brokerage firms across the country, a screen lit up, something never seen before, a green computer terminal filled with ticker symbols. Stock prices flowed across the screen, not on paper, but in light. That day marked the birth of a system that would launch the modern era of electronic markets, NASDAQ. Do you know its most striking feature? It never had a physical trading floor. In this video on Stock Market Historian, we explore the origin story of NASDAQ, how a stock exchange with no physical trading floor became the second largest exchange in the world. By the 1970s, the New York Stock Exchange was the most prestigious market in the world. However, getting listed there was not easy. Thousands of companies not listed on the NYSE had their shares traded outside organized exchanges. This market was called over-the-counter, or OTC. There was no central trading floor. Brokers called each other on the phone, asked for quotes, negotiated, and executed trades. Price information was distributed through printed lists called pink sheets. These listed broker phone numbers and indicative prices, but those prices were often outdated, sometimes hours or even days old. Investors often did not know the actual price at which they would trade. Transparency was limited, and access to information was difficult. In 1963, the U.S. Securities and Exchange Commission, SEC, published a comprehensive report analyzing this market. The conclusion: the OTC market was fragmented, slow, and disadvantageous to small investors. The special study of 1963 recommended improving price transparency, better protecting investors, and enhancing the flow of information. The National Association of Securities Dealers, NASD, which regulated the OTC market, decided to develop a project to address these issues. In 1968, NASD awarded the project to a company called Bunkeramo. Interestingly, Bunkeramo was not a Wall Street firm. It was an electronics company based in Connecticut, with roots in the aerospace and defense industries. The goal was to build a system where broker-dealers could update their price quotes electronically. The project took 3 years and cost approximately $25 million, over $100 million in today's terms. One of the first purpose-built data centers in financial history was constructed, a facility filled with tape drives, black and white screens, and bundles of cables. By February 8, 1971, the system went live. Its name, the National Association of Securities Dealers Automated Quotations, NASDAQ. NASDAQ's first day was not glamorous. The system electronically delivered price quotes for about 2,300 OTC stocks to 500 brokerage firms. There is an important detail here: NASDAQ initially was not a trading system, but a quotation system. Brokers could see up-to-date prices on their screens, but trades were still completed over the phone. This may sound simple by today's standards, but at the time it was revolutionary. For the first time, brokers across the country could see the same prices simultaneously. Fully automated electronic trading would arrive gradually in the following years. The NASDAQ Composite Index began at 100 points on its first day, and by the end of the year it remained around that level. At the time, no one could predict what it would eventually become. The man leading the system was Gordon Macklin, who served as president of NASD from 1970 to 1987. He advocated a radical idea for the time: if computers could connect broker-dealers, then a physical trading floor was unnecessary. NASDAQ became one of the first major markets to operate entirely without a trading floor, helping to initiate the digital transformation of capital markets. Meanwhile, the NYSE continued operating under a tradition dating back to 1792. Brokers gathered in a physical space and traded face-to-face by shouting orders. NASDAQ chose the opposite approach. It never had such a centralized trading floor. This difference was not just a matter of method, it was a fundamental shift. NASDAQ's wall-less exchange model allowed a broker anywhere in the country to access the same information at the same time, without going to New York. This was one of the first major steps toward the geographic decentralization of the financial system. Another defining feature of NASDAQ was that it was more accessible than the NYSE for newer, high-growth companies. NYSE listing requirements were stricter and geared toward larger, more established firms. NASDAQ became a natural home for emerging technology companies. In 1971, Intel went public on NASDAQ, becoming one of the earliest examples of the long partnership between NASDAQ and technology firms. Apple followed in 1980, and Microsoft in 1986. Over time, NASDAQ evolved from a simple quotation system into a fully electronic trading platform. In 1985, the NASDAQ 100 index was launched, tracking the largest non-financial companies listed on the exchange. By the year 2000, the NASDAQ Composite Index had risen from 100 points to 5,000, its peak at the time, marking the height of the dot-com bubble discussed in the previous episode. When the bubble burst, the index lost 78% of its value. But the system itself did not collapse, it survived and gradually recovered over the years. Today, NASDAQ is the second largest stock exchange in the world by market capitalization. Thousands of companies are traded on it. In more than 50 years since its founding, it has never had a physical trading floor. NASDAQ's legacy can be summed up in one question: does a stock exchange need a physical structure to exist? In 1971, the answer was no. That answer laid the foundation for today's fully digital global financial systems. In 1792, 24 men gathered under a tree and built a system based on trust. In 1971, trust was no longer based on a handshake, it was embedded in digital systems. Two exchanges became the answer to their respective eras. One relied on face-to-face human trust, the other on the instant accuracy of machines. Yet both were trying to answer the same question: how can a market be made fair, reliable, and transparent? If you enjoyed this video, don't forget to subscribe to the Stock Market Historian channel. We will continue exploring the stories that shaped the history of financial markets.